dear friends, this is Dr. Amarjeet Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. This is my privilege that I am here with you to talk about innovative debt instruments. So, this is the series we started in the last 2-3 sessions where we were talking about sources of financing for any business. So, we have in detail talked about equity share, preference share, we have talked about many more instruments. In today's session, I would be covering two important debt instruments. So, every company needs funds, that goes without saying. In fact, finance is the lifeblood of a company. A small to big businessman would be struggling to arrange for funds, for expansion, for day-to-day operations, for supplies, to meet up the legal requirement, be it tax payments or be it dividend payments or be it interest payment or principal payment. So, we need funds to run our show for sure. Now, the sources of funds primarily are divided into two parts: the owner's fund, which we call as equity, or the debt funds, which is the loan in the most simplest form, the loans or the advances we take from others. Okay, so companies obtain those debt financing by raising debt to general public, be it in the form of debentures, bonds, or any innovative name which I am going to discuss in very soon could be used. But primarily what is happening in debt financing, the issuer, which is the borrower, the issuer of the debt, is issuing some debt security, whatever the name we may give it to, based on the features, and that corporation's bond or promissory note is is basically debt. So, and the instrument which company issues promising to pay back the debt they have taken from the general public is known or could be known as debenture, bonds, or any innovative zero based bond, or there are a couple of names we are going to discuss. So, the point I am making is this, that in India, even as of date, even RBI allows a couple of innovative debt instruments apart from the debentures and bonds, which are commonly known, have been talked a lot in the last 4-5 decades. But nowadays we have innovative debt instruments which are traded in the capital market or debt capital, and the interest which is payable to the investor may be either at the fixed rate or flexible rate. It could be market determined or market linked or linked to some standard or benchmark. So, there are so many provisions, so many variations possible to be made in the debt financing. So, that is how we have so many variety of innovative debt instruments, because companies can play with these, be it the the date of interest to be paid, the principal amount to be paid, or discount being given, or how the payments would be made, or how the interest would be calculated. So, these are the few areas where companies can tweak with, and they can actually offer interesting options of debt to the general public. So, what is debt in innovative debt instruments? Innovative debt instruments in the capital market, they act as an IOU between the institution and the purchaser, whosoever purchases that debt. The purchaser would be generally a general public, but the purchaser could be an institution as well. You may have heard a couple of companies like LIC, banks of special importance, they keep on investing in the debt offer of other businesses. So, they may take a job of an underwriter, where they undertake to the purchaser, to the buyer of the debt, that particular bank or financial institution or a non-banking financial institution, that we undertake as an underwriter to ensure that your principal money and your your interest is paid as per the terms and condition of the debt mentioned on the face of the instrument, right. So, this is what this is how the debt instrument may work. So, individuals, institutions, they actually become the investor, they do not become owners, unlike the investment in equity. Here the people who invest or the institutions who invest in the debt funding for a company, they provide lump sum money and then they become investor, they become lender to the business. The issuing company, they guarantee that the investor will be paid fully whatever the amount of the investment they have made in the business in the form of lending loan to them, or be it debenture or bond or any other instrument. So, the issuing company assures, gives guarantee, or sometimes that guarantee is in actual in the form of a mortgage, sometimes it is without any mortgage, but that piece of paper in itself is a guarantee, it's a legal guarantee. Any investor who has bought the debentures or have given debt to the company is rightfully owner of that much amount of the investment, not the owner of the company, and can actually pull a company to the court of law to recover that investment, to recover that money which he has or she has lended, and also for the interest. So, that gives a that piece of paper which we call as a bond or a debenture, that gives guarantee to the investor that company will pay you fully the amount of investment along with the interest on that investment. And the cost for these payments or the contracts, often they include settlement of interest over time. The interest generally is generally is paid twice a year, but on innovative debt instruments the pattern of interest would vary, that would not be like a common debt or bond. So, that interest which a buyer pays to the seller, I mean to the debt holder, the company which pays to the debt holder is the income for the debt holder, right. So, that interest is something, that is what an investor is earning. So, friends, this was a brief background about what is debt, how the debt instrument work. So, my objective of this session is to talk about debt instruments. So, there are so many debt instruments, we will be covering all of them in couple of sessions in future as well. And today I would be talking about zero interest bonds and deep discount bond. Just have a look that how many debt instruments do we have. We have zero interest bonds or debentures, we have deep discount bonds DDBs, we have secured premium notes SPNs, floating rate bonds, we have callable or puttable debentures or bonds, we have market linked debentures MLDs, we have green bonds GBs, NCDs with warrants, we have payable payables when able, PWA structures, like they are very unique ones, payables when able, so PWA, innovative perpetual debt instrument, and then we have asset backed securities ABS. So, these are and companies can make more variations and actually name anything, but these are the widely accepted innovative debt instrument which I shall be discussing in today's session and in future sessions as well. So, in this particular session I am going to talk about first two ones, zero interest bond, and then we will take up the second one. So, first one I want to talk is zero interest bonds. A zero interest bond is also known as zero coupon bond, is a debt security that does not pay regular interest to investors. So, instead it is issued at a deep discount to the face value, and the investor receives the full face value when the bond reaches maturity. So, what happens when a company is issuing a debt instrument, right? So, and let us say the debt instrument, the face value of the debt instrument is 1000 rupee, and company is in not a very good condition, company cannot issue it at a premium, or company has a compulsion to issue it at a deep discount, so that people would pay about 20-30% of the face value, and the money will be given for a good long period, and then the company will pay back after the maturity is due, or at the time of maturity of the debt instrument, the face value. So, if the face value was 1000 rupee, it was given, a deep discount was given, and it was issued, let us say, at 200 rupees only. So, the difference, so 800 is actually not being paid by the lender, it is just been not received by the company. Company just received 200 against the face value of 1000, right. So, this would be known, the difference of 800 would be taken or known as deep discount, right, to the face value. So, and the investor, this receives the full face value when the bond reaches maturity, be it 5 years or 10 years. Okay. The returns to the investors are, as I said, is the on this investment, everybody invests for a purpose, everybody invests for expectations of some returns. So, what are the returns here? The difference between the face value and the amount paid by the investor. So, the difference between the purchase price and the face value paid at the maturity is the return to the investor, right. So, let us say if the investor purchases 10-year zero coupon bonds with 2 lakhs face value for 120,000 as per this example. So, at the end of 20 years or 10 years, whichever the maturity it could be, he would receive 2 lakhs and his earning would be 80,000. So, this 80,000 is his net earning, right. This is just an example, you can assume any life 10 or 20 years. So, the difference between purchase price, which is 120,000 here, and the coupons 2 lakhs rupees, which is the face value, the zero coupon bonds face value 2 lakh. The difference 80,000 is the earnings for the investor, which will be earned later, right. So, the zero interest bond, how do they work? The first of all, there is a deep discount which is being offered. So, issue price is significantly below the face value, that is the first thing. The second thing is lump sum payment is made, the entire returns are paid in a single lump sum at the maturity. It means no interest is paid during the life of the product, during the life of the instrument, okay. And yield to maturity, YTM, the total return is expressed as yield to maturity. So, here in the example which we just discussed, we said the face value is 200,000 or 2 lakhs and the issue price was 120,000. So, the difference of the 80,000 was the earning. So, that 80,000 would be technically known as yield to maturity, YTM, in this example, because the lump sum of 80,000 including the investment, initial investment, would be paid back after the maturity is over 10 years or 15 or 20 years, right. So, this particular is the example of zero interest, no interest. So, there is no coupon rate, right. In ordinary debentures or any debenture for that matter, we would have a coupon rate mentioned, 9% debentures, 9% bonds, 10% debentures, 10% bonds. What is that 10%? That 10% indicates the coupon rate, the rate at which the interest would be paid to the investor. But here in these types of bonds, which we call zero interest bond, no coupon rate is mentioned, because there is no need for coupon rate. The person exactly knows that how much he would receive at the time of maturity. The difference of the purchase and the maturity is the earning. So, there is no role of coupon rate in case of zero interest bond, right. So, if I have to evaluate zero interest bonds or ZIBs, what are the merits and demerits? Let's talk about that. So let's talk about the merits first. What are the merits of zero interest bonds? The first thing is there is a guaranteed return. Number 2 is no reinvestment risk. Number 3 is compounding growth. Number 4 is portfolio diversification. So the first merit is that the returns are guaranteed. In the example we just took, the investor was knowing in advance, the day when he was deciding to invest, he knew that he would be earning 80,000, right? The 1,20,000 was the purchase price he was paying to the company. The amount which was going to company's pocket or company's account was 120,000, right? The difference and the 200,000 is the face value. The difference of 80,000 is granted as a assured return. So unlike in the dividend on equity or dividend on preference share or many more such investment SIPs where we are not sure that how much would be the return. So unlike those investment options, here the investor is sure and the company is also sure that how much they need to pay. They knew their responsibility in advance, right? Accordingly, or they can plan accordingly. So this is the first merit of ZIBs. Then second is no reinvestment risk. So let's say that company has given has assured you 80,000 of investment returns to be paid to you at maturity. Now that had it been annual coupon rate, had it been 6 monthly interest, then you would have been struggling to reinvest that amount, whatever you return, you earn as returns in the form of interest. Then it's not certain that you would be able to fetch. For example, if a debenture is issued in 2024 January and the rate of interest was 10%. So after a year and a half, 6 months, there is a possibility the rate of interest may go up or go down, but there is a likelihood that the rate of interest will go down. So that investor who is getting annual interest or 6 monthly interest would actually be having the reinvestment risk. He may not be able to get the same percentage of interest or returns on that amount which he earned. So earning upon earning is of the same rate is not certain. But here in ZIBs, the 80,000 which the discount is given actually is calculated basis on basis on the compounding, basis of the compound growth of the funds, right? So earning on earnings are considered, and that brings us to the third merit, that compounding growth is registered, is witnessed in zero interest bonds, because investor is actually getting interest over interest, right? The money is retained by the company, but they are going to pay you later, of course, but when the calculations are made, it has the compounding effect. So in actual, the investor is earning or is having compounding or compounded growth. And then the portfolio diversification. This is a good option to diversify your portfolio because you are certain about returns. This could be one of the good options people who would like to diversify, because it's not a great idea just to invest in only equity or only in debentures which have a straight coupon rate, because your coupon rate could be 6% when you invested for 10 years, and you never know, the returns in the market may go up, or the inflation goes up, your actual returns are not as you actually anticipated at the beginning of the investment, right? So if the whole investment is made in debentures or whole investment is made in equity, then our portfolio is not diversified. So this gives us as one of the option to diversify. So these are the merits. When it comes to demerits, the first point I want to make it, there is no regular income, taxations on imputed interest, inflation risk and credit risk. These are the 4 demerits. So, as we have understood by this time, there is no regular income. Whatever we receive in the form of return or income is towards the end, at the time of maturity, right? During the life of the investment, there is no regular income. So, the investors who are looking for regular income, this is not the avenue of investment for them. And then not only that, you are not getting any income during the life before maturity, but moreover, you are actually paying tax on the imputed interest at tentative. Your interest is not coming to your pocket or your account, but even then you are supposed to be paying tax on the imputed, possible, or as a guess on the guesswork, that this is the imputed amount of interest I am earning, because the 80,000 is being earned over 10 years. So, we know exactly how much we are earning per year. So, tax is been paid. So, no income, no cash inflow coming to the pocket of the investor, and nevertheless tax is going out of the pocket of the investor. So, that is a very big disadvantage. Then of course, inflation risk is there, which is not being taken care. Inflation risk is always there for most of the securities, so is here for ZIBs, and then credit risk is also there, right. So, these are the risks which are there as a demerits or disadvantages of ZIBs. Now, I want to talk about deep discount bond. The first one we talked about, zero interest bond. Now, it is deep discount bond, very close to ZIBs, but still I would like to explain to help you understand it better. So, deep discount bonds are long term debt instruments which are sold at a significant discount at their face value, very much like ZIBs, with no periodic interest payments as was done in ZIBs. Instead, investors earn their return from the difference between the discounted purchase price and the bond's full face value received at the time of maturity. So, you will think there is no much difference, but let me just go further and you will then realize. So, these bonds pay a significantly lower interest rate or no coupon at all, right. So, there in zero interest bond, there was for sure no rate of interest being mentioned. So, no coupon rate was there in ZIBs, but here in deep discount bonds, we may have very low rate of interest or no coupon at all. Both are possible. That is how the deep discounts bond DDBs are different from ZIBs, and DDBs are actually issued for a more longer life time period than ZIBs. ZIBs could be issued for 5 years, but deep discount bonds are generally for 20 years, 30 years, like that, right. So, even just a bond with a coupon rate that is far below the prevailing market rate, that is what is being offered in deep discount bond, right. A very low coupon rate, maybe for example, if the prevailing rate is 8% or 7%, you could be assured of 2% only, or 1.5%, 2.5%, right. So, these bonds are inherently higher risk investment, because the discount which we get is there, deep discount, but the coupon rate is very low. So, they are considered relatively higher risk investments, and what more, this is actually giving returns are assured, because the discount is very deep. So, there is a deep discount. So, if you reach to the maturity, you get a very good amount of face value of the property of the investment. So, it is a high risk, but high return as well. It is suitable to investors who are willing to take on more risk for the long term growth, because the investors who are looking for long term growth are the ones who would be investing here. And the maturity is actually very long. These bonds typically have long maturity, often as more than 5 years to generally 30 years, up to 30 years. And the interest rate sensitive. Deep discount bonds are interest rate sensitive. They are highly sensitive to market interest rates. They appreciate faster when rates fall and depreciate faster when the market rates rise. So, there is an inverse relationship. So, it means they are very sensitive to market rate. That is another feature of the deep discount bond, and they are issued, issuer's credit worthiness is a question. A deep discount bond indicates the lower credit worthiness, right, for the issuers, because it raises concern about the ability to repay. So, this is another feature, that the credit worthiness of the issuer who is issuing deep discount bond is questioned, is not considered very great, right. So, take this example. For example, in IDBI, this is a real example, so I can quote it for education purpose. That is why I am doing. IDBI deep discounts bonds were issued way back in 1992. So, Industrial Development Bank of India, IDBI, was one of the initial issuers of deep discount bonds in 1992. In India, the DB started in 1992. The face value of the bond which was issued by IDBI was 1 lakh, and to be redeemed after maturity period of 25 years, and imagine they were issued only at 2700. Such a deep discount, so you just forget about those 2700 you are investing for 25 years, but after 25 years you will be getting 1 lakh rupees, such a huge difference of about 97,300. So, that is what is actually a real example of DDB. Now, another example is the Sardar Sarovar Namarda Nigam Limited. They also issued deep discount bond, and deep discount bonds were issued in 1993 for a period of 20 years with a face value of 1,11,000, and they were actually issued only for 3,600. That is another example. When it comes to merits and demerits, very much like ZIBs, they are high returns but high risk, of course. They are offered a very low price and the long term investment option is there, and they are marketable, they can be sold in the market. These are the merits. Limitations are, there is no regular income, very much like ZIBs. The credit worthiness of the issuer is questionable, and inflation risk is there, because inflation could be at a higher rate what you get as interest, and high risk investment. So, the investment in ZBB is considered to be highly risky, because either the coupon rate is not there or very low rate, and the duration is very long. Because of the long duration, they is very unpredictable what will happen after 20-30 years. So, they become very risky. So, people who have enough or plenty of funds, who are looking for regular income and can wait for maturity of 25-30 years, are the right investors for this kind of investment. So, friends, with this I would like to wind up. Thank you very much.